Welcome to this explainer. Today, we're stepping right out of the textbook and into the real world of wealth creation. We're going to investigate exactly how real, aggressive capital growth is being achieved in today's market.
But first, I want to kick things off by asking you a pretty direct question. Are you settling for fixed returns? Look, it is incredibly easy to just get comfortable in our investment zones, right? We tuck our money away in traditional savings instruments because, well, they feel safe. But by doing that, we really have to ask ourselves, are we actually missing out on much bigger opportunities for aggressive growth?
So there's a really clear dichotomy in investing. On one hand, you have your traditional risk-averse savings vehicles. Think of Mana Saham Bumiputra, or ASB in Malaysia, which offers stable, fixed dividends. You know exactly what you're getting, and honestly, that's great for peace of mind. But on the flip side, the equity market offers dual avenues for wealth creation. You get dividend yields, sure, but you also get the absolute engine of capital appreciation. You're buying a piece of a living, breathing business that can grow its value exponentially over time.
To unpack all of this, we're going to follow a quick 6-step roadmap today. 1. Fixed returns versus capital growth. 2. Meet Powerwell Holdings Berhad. 3. The Sharia compliance test. 4. Riding the bullish trend. 5. Opening the financial books. And finally, 6. Macro outlook and risks.
Okay, starting with Section 1, Fixed Returns versus Capital Growth. The absolutely crucial thing here is understanding the environment we're operating in, which is the Islamic Capital Market, or ICM. This is a vital part of the Malaysian financial system operating right alongside the normal market, but it follows strict Sharia regulations. It basically provides a way to invest in economic development while rigorously avoiding any components of riba, which is interest, gharar, meaning uncertainty, and maisir, which is gambling. It's living proof that robust capital growth and strict ethical regulations can and do coexist beautifully.
Moving on to Section 2, Meet Powerwell Holdings Berhad.
So Powerwell operates primarily in the industrial products and services industry. But to really grasp what they actually do, think of them as the critical nervous system for modern infrastructure. They produce low and medium voltage switchboards and switchgears. Literally, without these components, the safe and efficient distribution of electricity in commercial buildings, automated manufacturing plants, and most importantly, Southeast Asia's massive booming data centers simply wouldn't be possible. They supply the literal power grid for the tech revolution.
Now check out this massive number. Powerwell currently boasts an outstanding order book of 116 million ringgit. And this isn't just a big number for the sake of it. This represents incredibly strong future earnings visibility. When a company has a backlog of secured contracts this large, it naturally becomes a major focal point for both institutional and retail investors who are hunting for reliable growth.
Which brings us to Section 3, the Sharia compliance test.
To earn and maintain a Sharia-compliant status from the Sharia Advisory Council of the Securities Commission Malaysia, a company actually has to clear 2 really rigorous hurdles. Step 1 is the core business screening. This ensures there are absolutely no prohibitive elements involved in their day-to-day operations. Step 2 is where they must pass strict financial ratio benchmarks, putting really hard mathematical limits on debt and cash.
Mathematically, this boils down to a strict 33% threshold. Conventional debt divided by total assets and cash placed in conventional accounts divided by total assets must both stay below this 33% line. Powerwell passes this test with flying colors. It takes the somewhat abstract concept of ethical compliance and makes it mathematically sound and deeply rigorous for Muslim investors seeking permissible capital growth.
All right, Section 4, Riding the Bullish Trend.
Getting into the technicals, the momentum here is completely undeniable. We've seen a substantial price rise from under 30 cents to roughly 84.5 cents. Plus, the stock is trading well above its 20-week simple moving average of 71.3 cents. Anytime a stock consistently trades above this moving average, it is a glaringly clear signal of buyer's dominance in a bullish market. It's moving in a beautifully established upward channel, consistently forming higher highs and higher lows. The trend is just undeniably strong right now.
Let's dig a little deeper in Section 5. Opening the financial books.
Boom. 19.25%. That is the return on equity, or ROE, for 2025. Now, full transparency, it is worth noting this is slightly lower than the 23.32% earned in 2024, mostly because net income dipped just a bit from 19.71 million to 18.77 million ringgit in 2025. But make absolutely no mistake, 19.25% is an incredible profitability result. It proves that management is highly efficient at generating actual returns on the money their shareholders have invested.
So, let's see how this builds into the broader valuation. Between 2024 and 2025, earnings per share, or EPS, dipped just a tiny bit to 3.23 cents. However, based on the 84.5-cent share price, the price-to-earnings, or PE ratio, actually climbed from 24.85 to 26.16 times. Think about what that actually means. Even with a slight drop in current earnings, investors are eagerly willing to pay a premium for this stock. Why? Because that massive 116 million ringgit order book we talked about earlier gives them supreme confidence in future revenues.
Now let's talk dividends, because this is where the story gets really interesting. In 2024, Powerwell paid a dividend of 2.0 cents per share. But in 2025, they slashed that in half to just 1.0 cents. This means their dividend yield fell from 2.37% down to a mere 1.18%, based on a very low payout ratio of 31%.
Now, at first glance, a dividend drop might seem like a huge red flag, right? But listen to this quote regarding the management strategy. In lieu of paying the dividends, the company will keep the money as reserves to facilitate future growth plans. This isn't a loss for the investor. This is a highly calculated sacrifice. Management is purposefully retaining capital to fuel their aggressive expansion. Honestly, this is the very definition of a growth stock strategy.
And here is the final, crucial piece of the fundamental puzzle. A debt-to-equity ratio of just 0.18 times. While it did bump up ever so slightly from 0.16 in 2024 due to a small rise in bank borrowings, 0.18 is still exceptionally low. It proves Powerwell operates with a highly conservative capital structure. They aren't relying heavily on borrowing to fund all that massive growth. This provides a massive financial safety net.
Wrapping up our analysis with Section 6, Macro Outlook and Risks.
The external tailwinds pushing Powerwell forward right now are incredibly strong. National GDP growth directly translates to more commercial and industrial infrastructure. Then, you have the ongoing massive boom in data centers across Southeast Asia, plus the rapid expansion of renewable energy projects. All of these macro trends essentially guarantee a rising long-term need for Powerwell's electrical distribution equipment.
However, to remain truly objective here, we have to impartially recognize the real-world threats. Their future earnings could absolutely be pressured by fluctuating raw material costs or broader inflationary impacts on labor, especially if they can't pass those costs on to consumers. There's also heightened market competition in the electrical equipment sector, and of course, the ever-present threat of potential interest rate hikes reducing overall market liquidity.
But let's connect this risk right back to our financial deep dive. Because Powerwell maintains that microscopic debt-to-equity ratio of just 0.18x, they are heavily insulated against the shocks of rising interest rates. While their highly leveraged competitors might drown if borrowing costs suddenly spike, Powerwell's conservative approach actively mitigates that exact macroeconomic danger.
So, we've looked at the data. We've seen a company combining strict Sharia compliance with massive order books, high ROE, and strategic retained earnings for aggressive expansion. So I want to leave you with this final provocative thought. Take a hard look at your own investment strategy. While traditional fixed dividends offer undeniable comfort, does your portfolio actually have the right balance of safe, fixed income and aggressive, fundamentally sound capital growth? Thank you for joining me on this explainer, and as always, I highly encourage you to keep questioning the numbers.